Hi, good morning, good afternoon, everyone. We'll just give it a couple of seconds or so for everybody to connect. I hope everyone's well today. Okay, it's 2 minutes past, so in the interest of time, we'll dive straight in. So hi, everyone, and welcome to this IAB Europe Economic Trends Forum, which is actually our last one of 2021. But I'm very delighted to be joined today by our Chief Economist, Daniel Knapp. My name is Laura Wakefield. I'm the Marketing and Industry Programmes Director at IAB Europe. And for those of you that aren't perhaps familiar with the structure of our Economic Trends Forums, so we started this at the beginning of 2020, and it was really set up to share kind of market analysis and insight for our members. And then, as you can imagine, the focus in 2020 changed slightly, and this was kind of centered around COVID and the impact that this had on the economy and our industry. We've then continued that conversation through 2021, and I've also more recently dived into some sort of more specific topics, including e-commerce and also the details of our latest ADEX report 2020. For today, we're very excited to take a look into 2020 and share some predictions and market insights into what we can expect for the year ahead. Just before I hand over to Daniel to kick some things off, just a little bit of housekeeping. So this event is live, which means we do encourage, if you have any questions, to please share them for Daniel in the Q&A box, which you can find at the bottom of your screen in the interface. We are also recording this event, so we'll obviously make sure that we share this with you afterwards in case you want to go back and look over any of the details. But with that, Daniel, I'll hand over to you.
Thank you very much, Lauren, and hello, everybody. Great to be here again. And this is, as Lauren said, the last Economic Trends Forum of 2021, but certainly not the last that deals with the positive and negative knock-on effects of the structural changes we've seen in the digital advertising industry. And in a sense, it's Groundhog Day again, with the Omicron variant. Suddenly the focus on e-commerce and other things that we have developed in 2021 kind of takes a background role, as there is increasing concern about will we see a recreation of 2020 as we dare an outlook into 2022. The good news is we don't think that's going to happen. We believe that digital advertising spending is going to maintain robust in the year to come. This is part one of a two-part prediction series, which we're doing right now and at the beginning of 2022. What's the difference? Today, we are really going to look at digital ad investment predictions in the context of the macroeconomic wider structural development. In part two, which follows in January, we look at what does all that mean for the market participants in our sector, from advertisers, publishers, agencies, ad tech intermediaries, and also new players that are coming into the market. So without further ado, let's dive into part one. And are we doing this again? Forecast on quicksand. It was around mid-2020 that I wrote an article for Walk titled Forecast on Quicksand, saying that the economic or predictive foundations of reliably looking into the future have disappeared. And are we, with new economic uncertainties, again in that position? In a sense, yes. In another sense, no. Number one, we know that traditional macroeconomic indicators, GDP and so forth, they are, number one, far too slow to anticipate how an ad market is going to react to a very volatile and fast-paced economic environment. But on the other hand, on the positive side is there were some key learnings from 2020 that we can take, that the sector has built up some, in a sense, strategic resilience towards these short-term trends. So while there is a risk that things change and we have to regularly reforecast things throughout 2022, we believe that we're in a better position now to make predictions than we were at the beginning of the pandemic. Before we dare and look into 2022, let's really recap of where we are in 2021. And I believe this is a position that is far better than many of us expected. In 2020, as you recall, we had a 6.3% year-on-year growth for digital ad spend in Europe. This was the lowest growth since we started sizing the ad market, but in the context of number one, digital ad spend maturity, which in 2020 was around 56.5% of all ad spend in Europe, and the economic environment, this was a pretty solid performance. Now, in 2021, we saw a massive rebound of nearly 30% of growth. Partly this is a mechanical rebound due to spending that wasn't realized in 2020, but also with the explosion of streaming, with the wider changes in consumption patterns and e-commerce, there is also a structural accelerant here in 2021. And the good news for 2022 is that although the cyclical effect of a rebound from 2020 is not going to be there anymore for digital, the structural factors that have been put in place are going to continue to drive growth. But before we go into ad spend, let's abstract a little bit and see what does the picture look like from an economic perspective, i.e. the broader enabling foundations of ad spend overall. And I think these impact different formats very differently. So in 2020, we had a very heterogeneous growth picture in terms of formats. In 2021, with many formats exceeding 40% of growth. And this was largely because of organic drivers decoupled from the economy. If we now look at the economy again, what is really going to happen? The key question is, can this strong growth, this exuberance we saw in 2021, can it continue looking forward? The good news is that the business and consumer confidence indices, they remain up. The last data we have is from October 2021, so before the Omicron variant introduced some new uncertainties, but we can see the levels are overall on a very high level and they have plateaued. Meaning that it's very unlikely that they will drop again to even remotely close to the levels of mid-2020. Meaning we will enter 2022 with higher consumer and business confidence indices than we had even on average in 2020 and at the beginning of 2021. And this bodes well for further investment climate. Now, we know not all things are rosy and there's some dark clouds on the horizon. There's exceptional consumer demand and it's paired with overall labor shortages, supply chain crises and so forth. And a great indicator for this is the World Container Index, which denotes what does it cost to ship a 40-foot container from Shanghai to Antwerp, from Hong Kong to Los Angeles and so forth. And we updated this index just yesterday to see how it's performing. In the last couple of months, there's been severe concerns that the supply chain crisis is going to continue to rise. And indeed, container prices in the last couple of months have been up by 291% year on year, which is a major concern. And we can still see right now that while prices remain very high compared to pre-pandemic, we saw a slight decrease from the peak level. Meaning that there is reason to believe that the supply chain crisis is slowly going to ease. Predictions say that from the IMF, from the World Bank and others, that we are expecting to see a continued disruption of the overall global supply chain until well into 2023. But the magnitude of this disruption and the sectoral impact, i.e. then the knock-on effects on digital advertising, are going to become more muted over time. Now, for advertising, I think it's important to understand that this supply chain disruption is affecting key sectors that are traditionally underwriting the growth of the ad economy overall. Most notably, we see a concentration here in the automotive segment, We can already see that automotive manufacturers are cutting back spend. If you look at Q3 company reports across Europe from broadcasters, but also from big online publishers and so forth. And you also see raw materials, oil and gas and chemicals, which are important for CPG, soap manufacturing, creams, and so forth, that they are being impacted severely as well. We can also see the electronic segment, key for digital advertising, being impacted. So here on this chart, we can see on this bubble, we can see the size of the sector. This is 2018 data. This is where we have it by sector, from economic research institutes. And then we see surveys from Euler Hermes and Allianz, who surveyed respondents in these sectors to see, is your supply chain disrupted? Are you expecting a severe impact? So there are some key factors or some key categories which are going to be affected. And we can already see that in the company reports. For instance, if we looked at the recent Volkswagen earnings, we saw that it was actually the semiconductor shortage in the electronics bit that is also affecting automotive suppliers and therefore the ability to produce and ship vehicles. We also saw across CPG companies, and here an example from Unilever, concerns about a challenging operating environment, mainly due to rising prices and a severely constrained supply chain. The good news for the CPG sector, as for advertising overall, is that the large CPGs, which control a vast share of ad spend, have very resilient supply chains and inventory management, and we believe they will not be severely affected by those shortages, in contrast to sectors that are relying on just-in-time delivery, such as the automotive sector. I think there's a point to be had here for digital in particular, about electronics, as I mentioned, but also about the broader retail sector. And there are, of course, interaction effects between retail and CPG. But the main thing for the retail sector and the e-commerce boom that we have had in 2020 and 2021 is that a lot of it relies on products and shipments from China. If you look at the largest stores on Amazon, for instance, strongly driven by Chinese goods or actually being Chinese sellers, i.e. there is probably around 10% of overall European digital ad spend we're estimating right now, which is coming from international spend in China. And that part of spend is likely going to be affected as the supply chain disruption continues to persist. European markets overall are differently exposed to the combination of supply chain disruption and the accompanying labor shortages. Overall, we're going to see stronger effects in Central and Eastern Europe, who, by the way, over the last years or so have already struggled with a more severe labor shortage than Western European markets. So it varies really by country, and we see the shortage of materials and equipment in particular within the EU27, within the industry sector in Western Europe, it being Germany and France who are being exposed. But there's some good news. And some of you may have followed some presentations I did recently across Europe in Stockholm, in Copenhagen, and Milan. And this was one of the charts that I showed to really say that despite all these concerns, the main drivers for the digital ad economy are largely detached from the macroeconomic environment, detached from GDP, but also detached from labor shortages and supply chain crisis. Indeed, there's a lot of cheap and excess capital flowing into digital transformation, into sectoral disruption, with new startups, scale-ups, venture capital money coming in to really change sectors overall. And this is predominantly because not only is the economy and how people are consuming goods and services changing, but money is cheap. So historically cheap that interest rates today are on a 5,000-year low, meaning even the ancient Egypts couldn't borrow money as cheaply as you can do today. And this influx of cheap money is supporting a lot of new businesses, which are often born in the digital world, i.e. digitally endemic, who also focus a lot of their marketing activity to grow customers, to retain customers, to upsell customers within the digital domain. And we all know that the digital ad sector is more widely exposed to small and medium-sized businesses or to digitally native businesses than, for instance, the Fortune 500 businesses, the CPGs, the automotive manufacturers, which are underwriting the other parts, predominantly the traditional mass media parts of the ad industry. When this money is historically cheap, we can also see venture funding in Europe hitting new heights. So if we look at the H1 2021 data, we can see that Europe is increasingly becoming confident in the venture capital space and in the digital transformation space, building its own position between the US and China. And of course, these businesses which are being funded here are funded on the premise of growth, of multiples, of exponential growth. And that growth, of course, needs to be unlocked. And increasingly, for those businesses, advertising is not just a cost factor, but it's an investment factor intrinsically intertwined with the overall growth of the company. So it sits elsewhere on the balance sheet and therefore is not being cut easily in terms of crisis or uncertainty, on the contrary. Beyond large companies funded by venture capital, we can also see a resurgence in business registrations. Across the European Union, we've seen in 2021 the highest growth on record since 2016 when it comes to new businesses being formed. We saw, of course, a decline in 2020, but these new businesses that are being formed are often, again, digitally centered or take severe interest in the digital area with the kind of products and services they offer, thus more highly skewed towards ad investments in the digital domain as well. And we can clearly see this here, as I mentioned earlier, the exposure of some of these, many of these new businesses are small and medium-sized businesses, the strong exposure that they have to digital advertising versus the traditional advertisers. So major marketers in Europe, on average, spend about 40% of their budgets on digital. This is just paid media. Whereas if you look at small and medium-sized businesses, their exposure to digital is much higher. Initially, the budget allocation typically goes to search and social, as easy to use self-serve platforms. But as and if these businesses mature and grow in size, they are tending to diversify their investment channels in digital, meaning money also goes elsewhere beyond those channels here. Also, when we look at venture capital and in particular the IPO landscape globally, we can see that these companies invest massively in digital advertising. Here's a selection of recent 2021 IPOs, US companies where we have good reading on through SEC filings on revenue and marketing growth, but for good measure, also threw in Delivery Hero, a 2017 IPO from Berlin. And what you can see is, of course, remarkable revenue growth, which needs to be sustained to fulfill investor expectations, but also marketing growth, which tracks very closely revenue growth or in part even exceeds it. This is double digit. And if we add these companies here together, we have over 2 billion euros of marketing investment that's being put in here. You can see this benchmark group constituted of these 6 companies here, around 22% of their revenue goes into marketing, which just follows closely behind CPG firms, the traditional firms that have underwritten television and mass media for so long, whose history is closely intertwined and codependent on the rise of mass media. And a similar thing is happening with these companies as well. Some critics say that there hasn't been a brand that has been built on digital, but that's off on digital ads. But that's often not the point. It is, can a company be built using digital marketing investments? And the answer is yes. So this benchmark group in the 21st century fulfills with marketing similar functions that CPG firms use with mass media to build their brands. And this again, this change in how markets operate, how companies are driving growth means that we can look with less concern on the overall macroeconomic environment when it comes to growth in digital marketing. But we can't entirely disregard it, of course. So we have seen some calmer policy waters after the initial COVID disruption, but now with the Omicron variant, uncertainty is waking up again. What you can see here is a very fast-paced monthly update, or even weekly, sometimes even daily updated, depending on the country, indicator of market uncertainty called the Economic Policy Uncertainty Index. It comes from economists at key business schools, and the main premise was to build an indicator of economic volatility that is more fast-paced than the often slow GDP revisions we have from the World Bank, the IMF, and so forth, which occur quarterly at best, but often only biannually. This indicator doesn't tell us how good or how bad the economy is doing as such, but it tells us, looking at economic forecasts, but also fundamentally looking at the press coverage of the economy, whether there is consensus among policymakers and economists regarding the direction of the economy and what economic policy interventions need to be done to sustain economic growth. And the higher this index is, the higher the uncertainty. And we can see some key events in the past that have driven this uncertainty. The financial crisis in Europe here, this is, by the way, always Europe only. The Eurozone crisis, Brexit was really the most kind of uncertain policy event in Europe. COVID, lower than Brexit, but higher than Eurozone and the financial crisis. But we can see, if we look at the preliminary data for November 2021, we can see a slight uptick again with regards to the Omicron variant after COVID-related concerns have been slowing down. So this is an important index which we are going to monitor in the future as well to see whether this changes systematically. Again, we believe that the impact on digital ads will be negligible overall, but massive changes in this, spikes in this, might in particular change investment decisions by large marketers, i.e. one important component of the overall digital ad sector. The good news here is that economic uncertainty has not ceased to be, but has become a less important factor for marketers in making advertising investment decisions during the pandemic. So here's a recap of an analysis we did between the relationship between lockdowns in Europe and media spend. And we can clearly see, so 3 lockdowns in 2020, we saw full panic mode when the first lockdown came and the economy grounded to a halt. We saw around an 18% net impact on all media ad spend in 2020. That first lockdown came. A November lockdown, which was often less strict in Europe, had a less severe impact. Then a more severe lockdown, December, January, again, a slightly more severe impact, but again, much less than in April. So we believe that marketers have learned to not shut spending overall, but to move it to other channels, to monitor, to become more experimental and more trial and error based, and reliant on channels that provide fast feedback loops to switch things off, to switch things on again as the economic situation and the kind of pandemic situation allows. So this should overall, again, give us confidence that even though we might see travel restrictions or new lockdowns coming in, that marketer reaction will not be excessive, minus those sectors which cannot obtain any customers, for instance, like the travel sector, which should in lockdown come, of course, will be impacted. But overall, I think we can be quite calm about this as an industry. Now, of course, apart from the economy, other dark clouds on the horizon, which might have a more immediate effect on digital advertising, and that is regulation. We expect that the regulatory battle is going to continue to heaten up in 2022. A systematic impact on different parts of the sector, from ad tech and ID solutions to agencies and publishers, will follow in our part 2 of the series. But let me just say this. We are now in an environment where there is significant uncertainty, not just of the phasing out of third-party cookies or the use of Apple's IDFA, but because of the Digital Services Act in Europe, where some parliamentary groups are proposing an overall ban on the use of any personal data in digital advertising and a switch to contextual advertising only. So this might have severe implications for how the industry can use data, can use targeting, and therefore potentially knock-on effects on digital ad spend. But we believe that similarly to what's happening with the macroeconomic environments, that this will not affect overall how much money goes into digital advertising right now, but it will affect predominantly where budgets are being allocated. It might affect also whether money is going into paid media or into marketing analytics and other solutions. So there is going to be a severely differentiated impact depending on where in the ecosystem you are, whether you are a publisher who can thrive in this world, whether you're an ad tech company who has a plan B and so forth. But it shouldn't deteriorate the overall investment climate for digital advertising. If we do a read-through on some of the economic challenges on a non-digital part of the ad sector, the TV industry, which has been growing surprisingly strongly this year, we can see the sector is currently stuck between cyclical and structural growth. So we saw massive growth, in particular in Q3 and in Q2. Italy, for instance, in Q2, up the TV ad sector by 66%. We saw, if we look at the recent results of ProSieben and so forth, a sustained growth beyond Q2 into Q3. Remember, we had very easy comparatives with Q2 2020, because this is where the majority of the COVID-related impact was. So continued growth here, but it's both cyclical and structural, and we can clearly see why. So we look at France, for instance. If we look at the company reports here, we can see it was the recovery overall of consumer spend. It was the Euro Cup football that was driving spend, so structural and cyclical factors. But there are other cyclical factors, for instance, the supply chain damper that's coming in Q3, Q4, already impacting spend. Germany, so far, broadcasters largely immune from that. Italy, we can also see a flattening growth due to supply chain issues, even more severely so in Spain, where we might even see the end of the year in TV growing into negative territory. UK still fairly insulated, in particular due to a video on demand boom, i.e. broadcasters really thriving in the context of the overall digital transformation of consumption that we have been seeing due to 2020. My main argument is that the TV industry is very hard to predict what will happen in 2023, 24, 26, and so forth, because the sector is currently stuck between cyclical and structural forces, which creates some noise around forecast accuracy. We don't think, again, that this is the case when it comes to digital. So let me share with you what our current growth expectations are. In 2022, we're currently expecting, yes, a slowdown from 2021, but still very robust double-digit growth of 14.4% year-on-year across Europe. These are the 27 countries subsumed in our ADEX study. And this growth is going to be higher than the average pre-pandemic growth since 2012. Of course, as the market matures, we're going to see a slowdown to single-digit growth at the end of our forecasting period. But given the size and the maturity of the sector, this is still strong. So despite macro, despite other factors, still continued resilient growth overall in digital advertising. And we did a little experiment here. We said, how did our perceptions of digital advertising growth change from pre-pandemic to a post-pandemic environment? So here's our 2019 forecast. Around exactly 2 years ago, we hosted a similar webinar where we looked at how do we expect growth in 2020 and beyond. This was before anybody had heard anything about COVID. We expected from 2019 a continued slowdown of growth in digital advertising in aggregate as the market was going to mature. And we believe that the structural factors which have really propelled the sector forward due to the pandemic, that they were not coming at once, but slowly and glacially. So slow digital transformation continuing to fuel the sector, but not driving a massive spike in ad spend. This prediction clearly hasn't held up. So fast forward, and in 2021, we are seeing this picture. So overall in 2020, the real growth was only around 4.2 percentage points lower than what we had originally predicted. But the massive growth in 2021 is more than double, nearly triple of what we had initially expected. And this outperformance of growth, remarkably, is going to continue, we believe, long term. So it's not just a short-term correction of growth forecasts until we are back in the old scenario. We are now in a new scenario, which is based on different premises of digital transformation and so forth, which means that in net terms, the pandemic has been, despite everything, a positive for the digital advertising sector. And this translates into the following spend figures. We're expecting that by 2026, around a 29 billion euro additional spend bucket is going to come in versus our pre-pandemic forecasts. And you can see the sector only lost around 2.7, 2.8 billion in 2020 due to the pandemic. And already we've net additions of over 10 billion in 2021. Let's look at different formats. And I already showed that we had very strong growth in 2021, and we expect double-digit growth across all formats, even if it's about directories this time, to continue in 2022. Clearly not as high as 2021, but I think it's remarkable that the slowdown is less severe than one would have expected. Yes, we're seeing a strong correction in search, for instance, impacted by the travel sector, but also the structural saturation of search, which is not vertical search, i.e. search on, for instance, Amazon, retailer sites and so forth. That's going to grow very strongly, but the predominant bit of search is still not vertical search, and that is going to slow down massively. Audio, very nascent market, only around 550 billion euros right now, so very, very strong growth from a low base. Video growth continuing predominantly from social, but also from broadcasters. So we believe broadcasters are going to have the ability to maintain their share or even slightly grow their share in the overall video ecosystem versus the rest due to consolidation, due to the valuable audience, and also the shortage, again, another shortage, but here the shortage of media inventory supply, which is going to drive prices up. But remarkably, also social is clear, but also the non-social display part we expect is going to grow. Yes, there is some video in here, which is skewing it slightly, but it also means that if we see, as we see in particular due to the e-commerce boom, massive price inflations on some of their walled gardens, we see advertisers going out of there and trying to use the open internet to acquire and retain customers in a more cost-efficient way. How that's going to be possible beyond 2022, of course, is open to debate. And we're going to focus on that in part 2 of our series. But right now, the picture across formats is quite healthy in Europe. If we look at it on a by country perspective, a few things stand out. So what we did here is we looked at ad spend per capita and the compound annual growth rate, i.e. the average growth rate between 2021 and the end of our forecast period in 2026, and we got the size of the market in 2026. So this kind of gives us a peek into the future, how different markets are going to relate to each other. If you recall my ADEX presentations, which look at 2020 and 2021, we can see a clear breakaway group when it comes to digital maturity and also growth. And these were the Nordics and the UK, which have been growing despite their maturity in line with the market averages. Plus, we've seen explosive growth in some of the less mature regions. But there was a concern that in particular, the markets kind of stuck in the middle, the big markets of big industrial Western economies, France, Germany, and so forth, were lagging behind. That's a picture we'd seen consistently over the last 5 years, where France and Germany were behind average European growth rates and market maturity. 2020 has changed that, where we saw a fast forward acceleration of growth, and we expect, in particular for those markets, this growth to continue, where France and Germany are going to close the gap slowly with the UK and with the Nordics. And also we can see that Turkey and Ukraine are really coming of age as really new massive markets. So if we look at the top markets, we can see UK, Germany, yes, France, but then we're going to see Russia and Turkey being larger than, for instance, Italy and Spain. So a change in where growth and also where market size is really coming from as we look into the future. And I recall in my last webinar, some of you asked to provide some context to other markets in the world. So how is Europe performing overall? If we look at digital ad spend by region, combining our data with the latest Group M data, we can see Europe is smaller than both the US and China, and it's going to remain that. But if we look at the compound annual growth rate, we can see that Europe is growing slightly faster than China, but slower than the US. So Europe is not going to make massive moves on a global scale, but it's growing in line with or even slightly faster in aggregate than some of the largest markets in the world, meaning that Europe will remain a key investment area for digital advertising. It's not included here. I think what's incredibly important is that we look at India, we look at Vietnam, Thailand, Malaysia, which are all going to be the big growth markets. But in terms of absolute size, I think this is the most relevant comparison to see Europe. And if we look at marketers with a global remit, they cannot ignore Europe due to the size of the consumer market and also because of the maturity of the digital ad ecosystem. I think the key question, again, one that we're going to analyze further in part 2 of our series, is where exactly will this growth happen? And although I said initially that the investment climate is positive, there's going to be a differential impact when it comes to which player is going to benefit. Overall, with the number one, the rise of e-commerce, but also secondly, the concerns about the use of data, we're going to see a fragmentation of the internets. Google, Apple, Facebook, Amazon internets, we all know them. We see increasingly new walled gardens emerge, challenger walled gardens, which are all based on reducing the gap between the ad exposure and the convergence, and ideally putting that into one app. So not doing that in the open internet through intermediaries, but compressing that in one app. And this is predominantly where we see growth happening. And we can see, in particular in the CTV world, also walled gardens emerge, or in the kind of, I call it Europe Inc., i.e. large European players either going alone to consolidate. Think of Bertelsmann recently putting all the RTL and Gruner & Jahr assets together in one consumer platform with one login, or also stronger alliances in Europe. So this is where we believe growth is going to happen. And the open internet, we really believe, is facing quite some concerns here, as we also see fragmentation within that, depending on IDs, flogs, the anonymous web, and so forth. But again, that's something to be analyzed in more detail in the later series. Just a sneak preview, we started recently to analyze in more detail the retail media market, which we see as a proxy for these new fortresses where data, content, and conversion all collide and come together. This market is only partly reflected currently in our overall market sizing. We believe only around 40% of that market is currently reflected in our and others' ad sizing statistics. And this market is going to grow healthily to nearly 30 billion in 2026. And it's those kind of areas where we're going to see major growth. Anybody who can combine data, content, and conversion into one single platform. And new players are going to emerge on that basis. Uber launching ads, maybe buying an SSP, etc., all going to happen. Beyond that, though, I think it's very important to see that with this uncertainty and the role of data, digital ad spend is not just about paid media. Increasingly, we are seeing marketers allocating digital budgets, not just to paid media, paying to deliver an ad to a consumer, but into technologies, insight tools, analytics, etc., to make sure that their digital marketing really functions well, data management, etc. These are, of course, often attached to paid media, i.e. making it work more effectively, efficiently, monitoring and controlling it, but it also comes from different pockets of money. And if we look at some data blended from different sources, we can see that in Europe, marketing, i.e. the non-paid media bit, as a proportion of media and marketing investments, is going to grow. So, key implications for anticipating 2022. What's going to happen? Forecasts, again, are on a shaky foundation, so we will review them. But we overall believe that despite us doing updates in Q1 and Q2 regularly to monitor the situation, that the impact on digital ads will be fairly negligible. We look at these fast-paced economic indicators that I mentioned to check, but I think we should be confident. Increasingly, we see macro conditions don't determine where digital ad spend flows and where it goes, in particular because we're now in an economy that isn't just supported by digital advertising, but we're in a digital economy that needs advertising as an investment. But also we need to look increasingly, we want to look at the health of the sector and see where investment opportunities lie outside of media spend, and understand that marketing budgets, when it comes to the orchestration of platforms, the future of data, and so forth, are going to widen in scope. And with that, thank you very much for your attention. And Lauren, let's open the Q&A, please.
Thank you so much, Daniel. So we've actually had a few questions come through, so we can kind of go through some of those. And if anyone else does have any questions for Daniel, do pop them in the Q&A. We'll make sure we address those as well. So the first question that came through, I think was related to when you were talking about supply chain disruption. So can you recall any examples, or can you foresee any trend in EU retailers switching, or at least considering switching, from the Chinese suppliers to those based in Europe?
That's a very interesting question. I think it depends on the types of goods we see. In particular, of course, mass goods, still low-end goods being manufactured there in China, and just because of the overall costs, it's going to hard to switch that. I don't have any example of retailers switching to European production. I think if that's going to happen, it's probably going to happen in more high-value sectors where the margins aren't as strained. But that's a great idea, something that we should continue to monitor.
Brilliant. And then this is kind of looking at I think where digital ad spend, and you're talking about privacy and things. So in terms of digital ad spend, do you think changes in privacy and tracking will impact the growth of newer digital channels such as digital out of home, CTV, and digital audio?
I think it's going to be a net positive for these channels. They've historically not been built on third-party cookies. They are often not one-to-one channels, but based on aggregates, on averages, on household or structure of passers-by, and so forth. So they are better suited often to dealing with these disruption because they're built on entirely different foundations. It also means it will be, for marketers, probably easier to get scale in a privacy compliant way. So it's a net positive. However, to really seize on this potential, these channels need to come to grips with measurement and standardization. Measurement remains a key issue in audio. Yes, we're seeing strong influx of money into the sector, but beyond experimental budgets, a lot of things are being held back by measurement. When it comes to CTV, and we focus on that separately in the next sector, in the next in part 2 of our series. Currently expect the CTV sector, i.e. all ad spend on an internet-enabled enabled TV, to be around 1.2, 1.3 billion euros, strongly skewed towards the UK. But we believe that while the main growth we could see in the sector was in the number of press releases about what's happening, this is going to change, and we're going to see 2022, 2023 as a real game changer for that sector in Europe. But again, measurement important, clearly understanding who's going to buy that and who's responsible in the agencies. What is CTV? We've got still varying definitions, which is causing confusion and frustration. Am I buying an equivalent to television, or am I buying banner ads on an EPG? This will be tremendously important to clarify in order to capitalize on the, well, privacy advantages that industry has.
Yeah, as you say, I think it's going to be really important, and we'll be following up as well with the kind of part 2 where we'll be diving into that a bit more detail. Another question that's come through just while we're on the kind of privacy sort of regulatory stance on things. So the challenge from regulatory changes seems to be growing stronger each month. There's the prospect of challenges coming from data protection authorities. How do you view these impacting growth?
As I said, overall, there is enough dynamism in the sector to sustain strong growth. There will be some marketers that are concerned by privacy invasions and are going to look more skeptically at digital ad investments. We believe this is going to be mainly large brand advertisers who are less, or whom the digital ad sector is less exposed to than other parts of the ad industry. So there will be some impact, yes, but we believe there are many companies that are now fueling growth in the sector which can't do without digital advertising. So it's going to be mainly a question of where is spend that needs to go into digital, where is it going to be allocated to? And there are two components to that. One is the channels, or the paid media channels, right? And that is it CTV, is it social, and so forth? And then is it these new walled gardens where data and commerce collide, providing clear measurement, etc. That's kind of the one component, and the other is how much of that spend is going outside of paid media, i.e. Data governance, data clean rooms, analytics, and so forth. So there's going to be enough money in the sector to sustain healthy growth, but for market participants, they need to be really strategic about finding where this money will be put in and develop an adequate strategy if they don't have it yet.
Okay, great. And then this is just going back slightly to the kind of ad spend and the sort of channels that are growing. So specifically, when looking at streaming platforms, are they part? It says, and what is their part in video? So how do the streaming kind of platforms contribute to that growth?
Yeah, so our video total includes broadcasters, so BVOD, AVOD, etc. So that's in there. We're not breaking out the exact size of streaming platforms versus short form video versus broadcasters, but we see ad-funded streaming platforms, maybe in particular those with a hybrid pay ad-funded business model, as going to be key drivers of video ad spend in the future, likely going to grow higher than average. We realize that the video sector has very different underlying dynamics: short form, vertical video, the creator economy, broadcaster video, or omni-channel video on broadcasters versus some native AVOD platforms. And in our next iteration of the edX study, we will for the first time provide more granularity on the subsectors of video so that those who use the numbers can make more strategic decisions based on those numbers.
Yeah, I think that kind of more granular detail around video will be really useful to a lot of people in the industry, and probably a lot of people on this call as well. So in terms of, so you mentioned fragmentation in the industry. Do you see fragmentation within SSPs and DSPs, or an increase of consolidation between the two?
That's a topic I really...
It's what we're meant to focus on, yes.
Really reserved for next time. It's a topic that I find very fascinating. Overall, what we're seeing is particularly in the open market, a commodification of demand and supply relationships. So recently conducted some analysis based on SSP's API data to understand where demand comes from and where unique pockets of demand may lie. And this is just the open market. But overall, we find that there are hardly any unique demand-supply relationships. Everybody connects with everybody. So that makes it often hard for, I think, SSPs in the open market to differentiate. Apart from client service, we look at formats as well, regions. So consolidation in that sense is due. We're also seeing on the demand side, despite many publishers getting demand from 200, 300 SSPs, a very strong concentration of actual budget. So around, you could imagine 95% of budget comes from 10 or less demand partners. So you have commodification on the one hand, you have super fragmentation with many, many different players. But when it comes to revenue streams, particularly for European media companies, there's a very strong concentration of where demand is coming from. And I'm expecting more direct relationships between DSPs and the sell side, consolidation on the SSP side, predominantly as retailers, as companies like Uber and so forth are building up their own ad offerings. And I think many ad tech companies who haven't been able to capitalize on that retail media boom or this kind of new content data conversion fortresses are going to find an interesting future there. But right now, I think also with the ID solutions, I think the market is oversaturated and consolidation is inevitable. Plus, we're already seeing it in the spend data that it's actually not viable.
Okay, and then this is actually, I think, more of a follow-up question to one of your previous ones. So, with regards to China, are you aware of any research coming that lower initial item costs for consumers may be offset by poor quality and needing to replace a given item fairly often, so that time and attention cost on top of monetary? It's in the chat box whether that helps a little bit.
I think it's a great question. I don't have an answer for that. I think it's a great master's or PhD thesis question. It's yes. A very complex question, which we haven't looked at because as the question suggests, it's very hard to quantify these things. So we really look at things that we can use as indicators into prediction models to understand where ad spend is going. And I think this is very a lot of different variables attached to it. It's a very complex thing that merits further investigation, but I'm afraid we haven't looked at that.
Yes. And then actually this is kind of just one sort of final question that I was thinking about as we're going through just before we sort of need to wrap up, unless anyone else has any other questions. So you obviously talked quite a lot about several impacts kind of, next year. Is there anything that you think that you sort of hesitated to maybe include in this presentation that you think might be actually interesting for 2022? So there's obviously so many things to consider.
I think from the macro perspective, those are the main things. I deliberately was light on regulation, just included the DSA bit. I think we're seeing regulators overall wisening up to big tech. If you look at just today's CMA announcement for asking Meta to reverse the Giphy acquisition, we're seeing the close collaboration also between the CMA and Google when it comes to the sandbox. We're seeing strong calls from Vestager and others to rather be fast than to be 100% accurate in terms of going against big tech. So I think 2022 is going to be very interesting here. Whether it's going to lead to a break above big tech, I'm quite skeptical there. But pressure is going to increase significantly.
Great. So thank you, everybody, for joining us today. Thank you also for all the great questions that have come through, and Daniel for another fantastic presentation. As you mentioned, we're going to be looking into a kind of part 2 2022 outlook that's going to focus a little bit more on some of the growth drivers in terms of channels and things, and dive into that kind of aspect of things a little bit more. So be sure to keep an eye on that. We'll let you know the date as soon as we've got it organised, and hope to see as many of you there as possible. But in the meantime, again, thank you, Daniel, for joining. Thank you, everyone that's on the line today, and enjoy your festive break if we don't see you again before. And we'll see you in the new year. Enjoy your day. Thank you. Bye.